In the world of money and power, big changes are happening. For decades, developing countries relied on Western lenders like the World Bank for infrastructure loans, always with strings attached. Now, China has emerged as a major lender, changing the rules of global finance. Understanding China's lending is crucial. It impacts millions and shapes entire economies. China's rise as a creditor offers new opportunities for countries seeking growth, funding projects others might avoid. But this new source of money brings tough questions. Are the loans fair? What happens if countries can't pay? China's approach to debt is very different from the West's. We'll explore how China became a financial powerhouse, what makes its loans unique, and the impact of the Belt and Road Initiative. We'll compare China's methods to those of the IMF and World Bank, especially when countries struggle to repay. The debate over debt trap diplomacy, the idea that China lends to gain power, will be examined through real cases like Sri Lanka and Zambia. By looking at the facts, we'll uncover the real impact of China's lending. The goal, a clear, balanced view of this new era in global finance. We'll weigh the benefits and risks of China's growing influence. This is the story of how China is reshaping the financial world, and what it means for the future of development. China's transformation from aid recipient to top global lender happened fast. As its economy boomed, China used its wealth to secure resources and expand its influence, especially in countries rich in oil and minerals. Today, China's lending rivals or surpasses that of the World Bank and IMF combined. State-owned banks like the China Development Bank fund massive projects, dams, railways, ports, across Africa, Asia, and beyond. China's edge? Speed and risk tolerance. Western lenders demand lengthy studies and reforms. China moves quickly, focusing on commercial value. For many developing nations, China is a welcome alternative, offering capital with fewer political strings. But the scale and secrecy of these loans raise concerns. Critics warn that countries may be taking on too much debt, too fast. The details of Chinese loans are often hidden, making it hard to judge fairness or future risks. This lack of transparency is a major worry for watchdogs and citizens alike. China's lending has opened new doors, but also new dangers. The world is watching to see how this financial experiment unfolds. In 2013, China launched the Belt and Road Initiative, an ambitious network of land and sea routes linking China to the world. The BRI is China's main channel for overseas lending, involving over 150 countries and hundreds of billions in promised investment. Projects like the China-Pakistan Economic Corridor and Kenya's Mombasa-Nairobi Railway showcase the scale. Power plants, highways, ports. For developing countries, the BRI offers a chance to build infrastructure they couldn't afford alone: roads, electricity, and trade links. China frames the BRI as a win-win: shared prosperity, better trade, and global connectivity. But critics see another side. Many projects are built by Chinese firms, with much of the money flowing back to China. Some projects are chosen for political reasons, not economic need, leaving countries with costly, underused assets. The BRI's promise is real, but so are the risks of debt and dependency. For leaders, these projects are symbols of progress, but sometimes the benefits don't match the price. The BRI is reshaping economies and sparking debate about who really wins. As the initiative grows, so do questions about its long-term impact. The world is still weighing the costs and rewards of China's grand vision. The terms of a loan can shape a country's future. Western lenders like the World Bank offer low-interest, concessional loans, often as a form of aid. Chinese loans, by contrast, usually come with higher commercial-style interest rates. This makes Chinese loans more expensive to repay over time. Western lenders often require political or economic reforms, so-called conditionality. China claims non-interference, rarely demanding reforms, but often secures loans with physical assets or future export revenues. Transparency is another key difference. Western loans are usually public, while Chinese contracts are secret, sometimes forbidding disclosure. This secrecy makes it hard to assess the true cost or risks of Chinese loans. Critics warn that hidden terms can lead to corruption and bad deals. For borrowing countries, China's approach offers speed and flexibility, but at a price. The lack of transparency and higher costs are real trade-offs. As China's influence grows, so does the debate over which model is better for development. The world is watching to see which approach will shape the future of global finance. The choice between China and the West is rarely simple. Each path comes with its own set of challenges and opportunities. When countries can't repay their loans, the response matters. Western creditors work together through the Paris Club, often forgiving debt or lowering interest rates. China prefers one-on-one negotiations, behind closed doors, and rarely forgives the principal. Instead, China usually extends repayment periods or offers new loans, providing short-term relief, but not reducing the total debt. This approach keeps countries in debt longer, even as it eases immediate pressure. Other creditors find China's secrecy and reluctance to forgive debt frustrating, complicating coordinated relief efforts. China argues its method is flexible and tailored to each country, but the lack of transparency makes it hard to know what deals are struck. For borrowers, relief is often temporary, the debt remains. For the global system, China's approach is a challenge to establish norms. The world is still learning how to handle debt crises in this new era. The stakes are high for both lenders and borrowers. China is often accused of debt trap diplomacy, lending to poor countries, then seizing assets when they can't pay. The most cited case is Sri Lanka's Hambantota port, where China took a 99-year lease after Sri Lanka struggled with debt. Critics claim this proves China's strategy is about power, not development. But research shows asset seizures are rare. Chinese banks usually prefer to restructure loans, not take over assets. Failed projects often result from poor planning or economic shocks, not a master plan from Beijing. Many countries seek Chinese loans for their flexibility and lack of political strings. The debt trap theory is popular, but the evidence is thin. The reality is more complex. China wants its money back, not someone else's port. The debate continues, but facts matter more than headlines. Hambantota Port is often cited as proof of China's debt trap diplomacy. The project began as a Sri Lankan idea, funded by Chinese loans after Western partners declined. The port struggled financially, and by 2016 Sri Lanka faced a broader debt crisis. To raise cash, the government leased the port to a Chinese company for 99 years, receiving $1.1 billion. The money went to general government funds, not directly to repay the port loan. This wasn't a seizure for non-payment, but a commercial deal to address a wider financial problem. The case highlights the risks of large, debt-fueled projects and poor planning. Sri Lanka ended up with an expensive, underused asset and concerns about sovereignty. Hambantota is less a debt trap, more a cautionary tale about decision-making and development. The lesson: big projects need careful planning and transparency. Zambia's experience shows the complexity of China's role as a creditor. Heavy borrowing for infrastructure, much from China, left Zambia vulnerable when copper prices fell and COVID-19 hit. In 2020, Zambia defaulted, triggering tough negotiations with China, Western governments, and private lenders. China's preference for bilateral talks clashed with Western calls for a unified approach. The process was slow, delaying relief and deepening Zambia's crisis. Eventually, China joined multilateral talks, agreeing to restructure Zambia's debt, extending repayment and lowering rates. This marked a shift, China cooperating with global creditors when needed. Zambia's case is a test for China's willingness to act as a responsible financial power. The outcome offers hope for better coordination in future debt crises, but it also shows the challenges of managing diverse creditors and complex debts. The world is watching how China adapts to its new role. China's rise as the world's largest official creditor has transformed development finance. Its loans have enabled vital infrastructure, fueling growth in many countries. For some, China's no-strings approach is a welcome alternative to Western conditions. But Chinese loans often come with higher costs, less transparency, and longer-term risks. When debt problems arise, China's reluctance to forgive debt complicates solutions. Cases like Sri Lanka and Zambia reveal both the opportunities and pitfalls of Chinese financing. The debt trap narrative oversimplifies a complex reality. Risks come from many sources, not just China's strategy. Sustainable borrowing requires responsibility from both lenders and borrowers, plus greater transparency. The future will likely blend Chinese and Western models as countries seek the best of both worlds. For developing nations, the challenge is to seize opportunities without falling into new traps.